Using Covered Calls to Tax Loss Harvest, Episode 29. Welcome to another installment of my Covered Call series. Other episodes are linked in the description. A lot of you have probably been having a pretty nice year so far in 2023. Hopefully you've made some nice gains on your stocks and collected additional premium selling options. I wanted to touch on one special case of tax loss harvesting for covered calls. In other words, offsetting your capital gains for the current year with losses on your covered calls this year. Tax rules for options is a very large and complex topic, so we're just going to focus in on one very specific scenario. So the scenario is you've sold or rolled out some covered calls to an expiration after the end of the current year. Since you sold this call, it's gone against you. The underlying has continued to go up. So as a covered call writer or seller, you're taking an unrealized loss on it. But you currently won't be able to realize that loss against this year's capital gains. The taxable event doesn't happen until one of these three things occurs. It expires worthless, but that's not likely here since it's probably pretty deep in the money and won't expire worthless. Number two, it's assigned, which will almost certainly happen after the end of 2023. So that won't help offsetting this year's gains. And number three, it's closed or rolled. So we're going to focus on this third option. Let's elaborate with some covered call tax Investopedia knowledge. This page is linked in the description and is a good read to understand some option tax rules. If the covered call is bought back, depending on the price paid to buy the call back and the time period elapsed in total for the trade, it may be eligible for long or short-term capital gains losses. We're going to assume that when you wrote this covered call, it was out of the money or at the money. If you're writing in the money covered calls, some different tax rules may apply. That's beyond the scope of this video. It's now July, a good time to start thinking about your gains and what losses you could use to offset them. Needing to offset gains is a good problem to have, but you might not have any obvious losers this year. So check if you have any losses on long-term covered calls, not expiring in the current taxable year. Here's some content from Tasty Trade about rolling options and the tax consequences. Again, linked in the description. Rolling trades. Even though you may not have closed out your rolled position, you realize a gain or a loss each time you roll. A rolling trade consists of closing a position and realizing a profit or loss, then opening a new position in its place. Now we're interested in finding opportunities in covered calls to realize losses for tax loss harvesting. But continuing with Tasty Trade, when you roll a short premium or long premium position, the closing portion of the roll would be a realized profit or loss, which is a taxable event. Even though the position is not closed in your eyes, rolls by definition are taxable events. So if you had covered calls on stocks that have really shot up this year, like Nvidia or Meta, which I'm showing year-to-date charts here, then you might have chosen to roll way out in the future to capture more of the price appreciation to a date where they don't expire this year and they've continued to go up. You would have realized these losses by default if they expired in the current year, so nothing out of the ordinary would have been required. But if you roll the expiration to a date beyond the current tax year, then action is required to harvest these losses. These are the ones you might miss as opportunities to realize some losses against this year's capital gains. If you have some cash in your account, you can do a debit roll to get your call strike higher and/or your duration shorter when you roll to realize these losses. This is a way to potentially fix your distant in the money covered calls to at the money or out of the money, while reducing your tax exposure for this year. Consider rolling it above its current price to avoid the special tax treatment for selling in the money covered calls. Again, you can roll the strike up to realize more of the underlying price appreciation while gaining a tax benefit to boot. Two birds with one stone. But it will require taking that loss on your current covered call and spending some cash in your account if you're doing a debit roll. Your broker will have realized gains information somewhere that shows you where you stand for the current year. Here's Schwab's. It's a tab in the transactions history page. Just below what I'm showing will be your year-to-date gain or loss. If it's a gain, this is the amount you can consider offsetting with losses before the end of the year. Then just below that will be all the realized transactions and their amount. Your broker might also have some tools to help you tax loss harvest. Schwab has them, but I prefer to do it myself. This is something you should check up on every month, especially as year-end approaches. If you have a lot of realized gains for the current year, then it can provide some incentive to sell your losers and encourage you to roll or close your losing covered calls that don't expire until sometime after the current year. To reiterate, the main requirements for using this covered call tax loss harvesting strategy are some taxable gains in the current year that you'd like to offset with losses. Second, some covered calls you sold that have gone against you and are now in the money and don't expire in the current year. And third, consider doing a debit roll to get the strike above the current price if you want to avoid special tax treatment of writing in the money covered calls, which can treat long-term option gains as short-term capital gains. If you still like the stock and want to keep owning it, roll the strike up as much as you can. But to accomplish this, you'll probably need to do a debit roll. If you're neutral or no longer want to own the stock at its current price, then consider buying to close the covered call and selling the stock. But first, carefully consider your capital gains or losses on the underlying stock as well. So let's go through an example of how this could work using Meta, which has gone nuts the first half of 2023. From 120 in January all the way up to 310 today. But first, if you're enjoying this content, please consider liking and subscribing. I'm not a financial advisor. This isn't financial advice, just educational and informational. I've been selling covered calls on Meta since it was much, much lower. I've rolled them up and out several times trying to capture as much of this price appreciation as possible, but I've taken it as far out in expiration as I can. I rolled back in April, around here, when Meta was 220. I'd previously rolled it out to January 2024 before this roll, so I rolled it out to the longest expiration available, a December 2025 leap expiration, which is way off the screen. 981 days to expiration at the time. And I rolled the strike up to 300. This is the leg I'll consider debit rolling at some point later this year for tax loss harvesting. Meta has continued to climb since I rolled back in April and has already blown past the strike in just 92 days. I've got a sizable loss now on my Meta covered calls, approximately an unrealized 5,400 paper loss on each contract. It's not catastrophic since they're covered calls, not naked, and I've tried to capture a lot of the price appreciation in this run, but I've got a long time to wait. I comfort myself by knowing I'm much better off than if I'd sold Meta close to the bottom. There's a good chance I'll use my covered call losses on Meta to offset my current year's taxable gains, I can't roll them out any further right now, but I can do a debit roll and get the strike higher. So let's see what's available for Meta calls in December 2025. So here's Meta's covered call chain for December 2025. My current call strike is 300. So let's see how much it costs. It's currently going for around 97.3. So I need to roll this one. I'd like to roll it up to at least its current price to avoid that special tax treatment for in the money covered calls. So I need to roll it to at least 310, which would cost me $735 a contract, or $730. Probably like to roll it up a little bit higher than that, maybe 350, which would be about $22 per contract, or 2,200. That'll give me $50 more of price appreciation by December of 2025. I'm not going to do this now. It's only mid-July. I'll wait until later in the year when I have a better idea of my gains for the year and what losses I need to harvest. Anything could happen with your current losing covered calls between now and then, so it may look completely different when we harvest our losses. But it's still wise to start thinking about it sooner rather than later. In conclusion, as the end of the taxable year approaches, be aware of your realized gains from dividends, premiums collected, and capital gains on stocks you sold. Your broker will typically compute that for you. You can look for opportunities to offset this taxable income by selling your losers, which could include stocks and your current covered calls that don't expire in the current year. I'm not a financial advisor or tax accountant. Please consider discussing how best to tax loss harvest with your investment advisor or tax accountant. Or better yet, further educate yourself on this topic before taking any action. If you enjoyed this content, please consider liking and subscribing.